Okay, ladies and gentlemen, good morning, everybody. Happy May 18th. Happy Thursday. This is a strategic day. I don't know if you guys realize this, but tomorrow is Friday, and it's the Friday of a long weekend. This is truly the beginning of several days of amazingness to come over the next couple of days. So what better time to huddle together and talk a little bit about taxation. Okay, so welcome, ladies and gentlemen. Welcome to the shareholder compensation advanced topics. You may recall that we had an initial session, shareholder compensation, the fundamentals, back in January, if I remember correctly. And back by popular demand, this is a continuation of our initial session where we're going to look at some further topics in the area of shareholder compensation. So welcome, and thank you for joining us here. Okay, just a very quick disclaimer, ladies and gentlemen. These materials were prepared for educational purposes. Naturally, I made every effort to make sure that there are no typos, errors, anything along those lines in the materials. But keep in mind, this is an educational seminar. If you have any specific fact situation, make sure that you review it as a qualified professional. All of you, ladies and gentlemen, are qualified professionals. So, don't take a slide from my presentation, send it directly to a client and say, do this. You might want to take a look at the client situation before you go ahead and do that. So please keep that in mind. Okay, you may recall, ladies and gentlemen, from a little while ago that we previously had a session on shareholder compensation. It was called Shareholder Compensation, the Fundamentals. And at that session, we looked at basically the following question. How should a shareholder pay themselves out of their corporation? Hopefully with the idea of minimizing any kind of tax impact. And you may remember from our original session that we looked at, well, what tax attributes might the corporation have? Is there something like capital dividend account, RDTOH, etc.? Are there certain kinds of payments that would make more sense to make first in order to make those payments on a tax efficient basis? And then ultimately, once you've run out of attributes to use, perhaps you do a bonus, or perhaps you do a dividend, or perhaps you do a combination of those two things. Maybe run a couple of mock scenarios and see which one gives you a better result. So that essentially was our initial session a little while back. In today's session, we're going to take a bit of a closer look at how do we physically go about making some of these distributions out of a corporation. So we'll first take a look at, how can we pay a salary or a bonus? Does it make sense to pay it to one person versus another? Are there any considerations or restrictions perhaps that we might want to be mindful of when deciding to pay out, let's say, additional salary or large bonus to someone? We'll then take a look at what if we decide to pay out a dividend? As long as a person is a shareholder, they can potentially receive a dividend. But there's something called tax on split income, otherwise known as TOSI, that we need to be mindful of in that context, particularly when you're dealing with a family business. What if you have a shareholder that doesn't hold common shares? What if they have preferred shares, or as they sometimes called special shares? Well, there might be a restriction on how much of a dividend you're able to pay, or potentially whether you can pay a dividend at all to a person who's holding those types of shares. In that context, there's a strategy that people sometimes use called a wasting freeze that perhaps might be beneficial if the shares that you're holding do not allow you to receive a large amount of dividends. And lastly, what if we have a trust that holds shares of a corporation? Can a dividend be paid to a trust? Well, the short answer is yes. What happens to the dividend after it is paid to a trust? How do we distribute that out to perhaps some kind of beneficiary? So we'll take a look at that as well. And lastly, you may recall again from our previous session on the fundamentals that we looked at a short case study. And we're going to take a look at that same case study now through this slightly different lens in terms of who should be receiving perhaps a dividend payment or a bonus payment. Are there any implications from a TOSI point of view, et cetera, et cetera. So hope everybody's excited. Hope everybody's ready to go. Let's rock and roll. Here we go. Okay, so ladies and gentlemen, first and foremost, let's take a look at the concept of paying out a salary or a bonus. Okay, in general terms, in order for a corporation to be able to deduct the amount of salary that it pays to someone or the amount of bonus that it pays to someone, the actual amount itself has to be A, reasonable. In other words, the amount of bonus or the amount of salary paid to someone has to be reasonable. And I'll talk on the next slide about what that means. And also, it has to be paid within a certain time frame. Specifically, there's a special rule. You've probably heard of it. It's the 180-day rule. You got to pay out your compensation no later than 180 days or 179 days if you want to be conservative in that sense. So the timing matters as well. Naturally, if you're going to be paying out additional salary or perhaps declaring a bonus, there's going to be payroll withholdings that are going to be necessary, as well as a T4 reporting requirement as well. So the question, first of all, comes, what exactly is considered to be reasonable? if you're paying out a bonus to someone, what's considered to be a reasonable bonus or a reasonable amount of salary, perhaps, to someone? And the answer fundamentally is this. There's been various CRA commentary and various court cases on this topic. And generally, what's considered to be reasonable is this. What would a reasonable business person pay to someone in exchange for whatever it is that they provided in exchange for that bonus or salary? So when you're paying out a bonus or salary, you're basically contracting somebody's labor. What would a reasonable business person pay by way of bonus or salary, to someone who was working for them, essentially? So in general terms, you would want to look at, well, what would be the arm's length salary or wage that an arm's length business would pay to a particular employee? What actual work did that employee physically perform? And this is particularly important in situations when you have a family business. If some of your employees, for example, are your children or your spouse or mom or grandma, CRA will likely be more particular about the payment of something to your relatives, because the question of, well, what is it actually reasonable or not, would be more pronounced in that context. For instance, you've probably seen situations where you might have a spouse who doesn't really do anything for the business. Well, can you really pay that person a salary? That would likely be unreasonable. Would a reasonable person pay something to someone who does nothing for the business? Probably not. So you got to look at what work is actually being performed by the person to whom you want to pay additional salary or some kind of bonus. If there is an unreasonable portion of a salary or a bonus that is being paid to someone, the outcome is going to be this. That unreasonable component will not be deductible to the corporation. However, employment income for an individual is taxable on a receipt basis, meaning if an individual receives some kind of employment income, that's going to be taxable to them. So you may end up in a situation where essentially your income will be double taxed. Income that was earned by a corporation is taxed once in the corporation. There is no deduction for an unreasonable salary or an unreasonable bonus. But then when that bonus comes out to the individual receiving it, it'll be taxed in their hands once again. So naturally, you would want to avoid this type of situation. Make sure that if you're paying out a salary or a bonus, the amount is reasonable in relation to the work that is being performed. Now, with this in mind, ladies and gentlemen, the Canada Revenue Agency has a long-standing administrative position specifically for active shareholders, This is found in Income Tax Technical News number 22, which seems to suggest that there was probably 21 other income tax technical news along the way. This was the 22nd one that they issued on this topic, perhaps. The policy says the following. If you're dealing with an individual who is a Canadian resident, this person is a shareholder either directly in the company or perhaps indirectly through a holding company. And most important, this person is active in the day-to-day operations of the corporation that is actually paying out the salary or bonus. Then for this kind of individual, the CRA will not question whether an amount is reasonable or not. So effectively, if you're dealing with an active owner-manager, you can pay them any amount of bonus, any amount of salary, as little or as much as you want. Effectively, because of their efforts, the company exists, and because of their efforts, the company earns income. So the CRA is not going to question bonuses or salaries paid in this context. But if you have a family member who's not active, who's not a shareholder, well, the question of whether something is reasonable or not will then arise. So keep that in mind if you're looking at salaries and bonuses. Next, when is a salary or a bonus considered to be paid, ladies and gentlemen? Well, ironically, CRA has a specific idea of what in their mind constitutes paid. I think to most people, paid means that cash leave the company and go into my wallet. That means I got paid. But in the context of a corporation, the CRA has a little bit of a self-serving position on this, which to be honest with you, kind of helps us accountants as well. The guidance that the CRA has is this right here. In their view, the best evidence of a payment being made, short of an actual canceled check or a transfer being made, is the fact that payroll withholdings associated with the bonus or additional salary were remitted on time. Okay, so essentially, as long as you pay the withholdings to the CRA, issue a T4, and the individual reports their income on the T1, CRA has collected what they wanted to collect, and they have really no reason to question whether something was paid or not at that time. This is confirmed as a specific CRA technical interpretation. Feel free to look it up if you'd like. Now, if you have a situation where a salary or a bonus remains unpaid after 179 days pass subsequent to the year end, well, at this point in time, your salary or bonus will only be deductible when it is physically paid. So commonly, when you're doing a year-end, for instance, it's very common to, for example, accrue a bonus because you want, to bonus out a certain amount of income or whatever the case may be. That's fine as long as once the bonus is accrued, it is physically paid out according to this guidance from the CRA by no later than 180 days of year-end. If it takes you longer than that to pay the bonus out, then the bonus will not be deductible at the time you accrued it. It'll only be deductible at the time it is physically paid. So there is a little bit of a leeway here in terms of 6 months, allowing you to pay it a little bit later, but any later than that, and you will lose the deduction for that bonus at the time of accrual. Okay, so that's some guidance on salaries and bonuses, ladies and gentlemen. Now, for dividends are a little bit of a different animal, all right? Keep in mind that a salary or bonus is paid really in exchange for labor. Somebody is working for you, and you're kind of paying them in exchange for the efforts that they're putting forth. But in order to receive a dividend is a distribution of profit by a corporation on shares that the company has issued to some kind of shareholder, okay? So to receive a dividend, a person has to be a shareholder. This could be either directly, perhaps an individual owns shares directly in a corporation, or perhaps it could be indirectly through a holding company, or perhaps an individual is a beneficiary of a trust, and the trust holds shares in the corporation. And in that case, the corporation can declare a dividend to the trust can potentially allocate it to the individual shareholder. Now, hopefully most of you know this, but I've actually seen a couple of cases relatively recently where some other accountants think that if I issue a T5, then that means I paid a dividend. Well, no. If you don't have a shareholder, whether you issue a T5 to that person or not, it does not make them a shareholder. Legally, you cannot pay a dividend to someone who's not a shareholder, whether a T5 is issued or not issued. So please don't think that, hey, I issued a T5, we have a dividend. Not necessarily. If the person's not a shareholder, that cannot be a dividend. So it's great that you issued a T5, but it probably shouldn't have been issued. Maybe that's a shareholder loan or something else, some kind of benefit. But anyway, you need to be a shareholder in order to receive a dividend. That's the key thing. Now, if you're going to be paying out a dividend out of a corporation, unfortunately, in 2023 and for the last number of years, there's a few little things that we got to look out for. The main one is the potential application of these rules called the TOSI rules. TOSI stands for tax on split income. And I'll talk about TOSI in greater detail a little bit later. TOSI rules are applicable for family members. If you have a family business that is owned and operated by, let's say, mom and dad, and there's kids, grandkids, grandparents in the picture, and they are somehow shareholders, either through a family trust or whatever. Well, that would be an example of a situation where TOSI may apply to dividend payments to those family members. And TOSI doesn't do anything that's good. TOSI does something very, very bad, which we'll see in a moment as well. So paying out a dividend, you got to consider this tax on split income here. Do we have to worry about that? If you have a shareholder that has shares that are not common, for example, preferred shares, or sometimes they call them special shares, well, there might be restrictions on the amount of dividend that such shares can legally receive. Or some shares that are special, for example, may not have the ability to earn dividends at all. So in that case, even though a person owns a share, if it's a special kind of share with certain characteristics, they may not be able to receive a dividend, unfortunately. Or if they are able to receive a dividend, it might be limited to maybe a lower number than you'd like to pay out. And lastly, if you have a trust with beneficiaries inside, well, you can pay out a dividend to the trust, and the trust can allocate that to a beneficiary as well. So we're going to take a closer look at all these things as we move forward, ladies and gentlemen. Okay, so first of all, let me tell you a little bit about this concept called TOSI. Okay, TOSI stands for tax on split income, tax on split income. And it's a series of rules that really were designed to try to prevent this idea of income splitting. Income splitting is basically, if you have a family business, instead of paying dividends and various things out of the family business to the main owner manager, maybe I can pay them out to their kids, their grandkids, their spouse. Perhaps they're in a lower tax bracket. And if they're in a lower tax bracket and I pay it to them, they're going to pay less tax. So we as a family now have more after-tax cash. That's basically the idea of income splitting. Well, unfortunately, the government's not a huge fan of income splitting. And as a result, the TOSI rules are something that we have to be mindful of. Now, ladies and gentlemen, just to kind of get a bit of a sense of your familiarity with the TOSI rules, I have a quick poll here. I have a quick question to ask of you, ladies and gentlemen. Let's pretend you are the owner operator of a CCPC. You are the main shareholder of an operating business. It's a CCPC, okay? Let's suppose you have a spouse, all right? Your spouse receives a dividend out of the CCPC. Maybe they're also a shareholder, but for some kind of reason, which we're gonna go into a little bit later, but for some kind of reason, your spouse's dividend is subject to TOSI. Here's my question to you. What happens to that dividend? What is the implication of some kind of income being subject to TOSI? So, ladies and gentlemen, I'm gonna launch a poll. If you take a look on your screen, you should see a little window come up with these 5 different possibilities. Take a moment, think about it. Please select the response that fits your understanding of what TOSI is. And if you're not sure, that's okay. Say you're not sure. By the way, the poll is anonymous, okay? So no one, not me, not Jeffrey, nobody will know what you said, okay? So completely anonymous. So please, what happens if TOSI applies? Okay, so we're up to about 75% of the folks responding. Fantastic. I'll just wait a few more moments here. If you get a chance, please let us know what you think. What happens if income is subject to TOSI? Okay, fantastic. So I think we've probably gotten most people that have participated here. I'll just wait 5 more seconds and see what else we get in here. Okay, amazing. All right, so let me share the responses with you, ladies and gentlemen. So correct me if I'm wrong, but I think at this point you can look on your screen and you can see basically a quick summary. So notice we got actually a pretty wide range of responses, which in my humble experience kind of reflects, you know, what people really know about TOSI. Some people know about it, some people don't, some people are a little bit confused, okay? Okay, some people think it's attributed from your spouse to you. In other words, instead of the spouse paying tax on that income, really the original owner is paying tax on that income. Is it deemed to be a shareholder benefit? Maybe. The correct answer, ladies and gentlemen, is C, okay? It is taxed at the highest personal tax rate in the hands of your spouse, okay? So when in doubt, pick C. So Jeffrey, I saw a touchdown, you got it, okay? 6 points, 6 points. So, ladies and gentlemen, TOSI basically means that that income is still received by the person who received it. In this case, it's the spouse. But unfortunately, they're going to be paying tax on that income at the highest marginal tax rate. They're going to pay tax on that income at the highest marginal tax rate. So notice, it kind of defeats the purpose of income splitting. The whole point of income splitting is to pay something to a person who's in a lower tax bracket than maybe the main owner manager. Well, if that other person is now treated as if that income is subject to tax at the highest marginal tax rate, well, then what's the point of paying anything to them in the first place? We might as well pay all that income to the individual main owner anyway. So that's really the outcome. Nothing gets attributed, nothing gets moved anywhere. It's just subject to the highest marginal tax rate, unfortunately, in the hands of the recipient, Okay, so as I noted just now, ladies and gentlemen, income subject to TOSI is highly taxed, okay? Subject to the highest marginal tax rate, and this is regardless of the actual income level of the person receiving it. Their actual level of income might put them into a relatively low tax bracket, but unfortunately, if a certain kind of income is subject to TOSI, that income automatically goes into the top tax bracket. If you have something called allowable minimum tax carryovers, okay? Unfortunately, you can't use those to reduce your liability on income that is subject to TOSI. And this is the other consideration that maybe not everyone is familiar with. Believe it or not, income that is subject to TOSI cannot be eligible for just about every possible personal tax credit, including the basic personal tax credit. As you may know, the basic personal tax credit is available to anyone who's an individual in Canada, regardless of age. You know, my 1-year-old daughter will get the basic personal tax credit. So in theory, if I try to pay her dividends, unfortunately, that tax credit will be denied, and even she will be subject to tax at the highest rate. With a couple of exceptions. The foreign tax credit available is, and the dividend tax credit is available as well. So really, TOSI defeats the purpose of income splitting, okay? So let me spend a little bit of time, folks, and I'll show you a little bit about what TOSI really does. And perhaps we're gonna use that a little bit later in our case study to see, maybe we can kind of plan a way around it. Okay, so a little sort of history lesson, ladies and gentlemen, and this was way before my time, certainly, but From what I hear, okay, back in the 90s, prior to 1999, it was hammer time, okay? Some of you folks will recognize the quote, hammer time, MC Hammer. Anyway, TOSI back in those days did not exist, all right, in the 90s. So apparently back in the 90s, if you had a family business, you could have a whole bunch of kids, pay each one a dividend, and they basically would pay no tax because it was the basic personal tax credit. So back in those days, apparently having lots of children was a good tax planning idea, all right? Now, unfortunately, this came to a bit of a crashing halt in the 1999 year. From 1999 onwards, the government introduced these new rules called tax on split income, but they were only applicable to income earned by a minor. A minor is somebody who's under the age of 18. So as a result, really at the time, TOSI rules were commonly referred to as kiddie tax. Some of you who've been around for a while may remember the term kiddie tax. It's what we used to call TOSI back in the day. Well, unfortunately, there were some significant changes that took place in 2018. Our beloved federal government, and I use the word beloved in a fairly loose context as I say these words, significantly expanded the existing TOSI rules. As a result, since 2018, TOSI can also apply to adults, not just necessarily minors. And there are now many kinds of income that could be subject to TOSI. Traditionally, it was primarily dividends. Well, now there's various kinds of other income that are also subject to TOSI as well. So this impacts whenever we pay anything out of a corporation, particularly to a family member. So this makes it very difficult, in some cases perhaps impossible, to pay something to a family member out of your company, unless you meet some kind of specific exceptions. So, ladies and gentlemen, here's a quick, I'm going to go through the next couple of slides relatively quickly. There's a lot of detail here, but the TOSI rules themselves get pretty detailed. So we can probably spend 2 hours easily talking about this, but I'll try to kind of narrow it down to the basics. Okay, since 2018, when does this concept of TOSI become applicable? It's applicable if you have somebody called a specified individual, if they earn something called split income, and if it's coming from something called a related business. So if you have those three parameters, specified individual earning split income from a related business, when those three things are present, that income to that person is subject to TOSI, i.e. subject to tax at the highest marginal rate. But there are many exclusions from TOSI. And if it's possible for this individual to meet some kind of exclusion, okay, then TOSI is not a thing that they have to worry about. And in my humble opinion, this is really the most challenging component of the TOSI rules. There are many, many, many different exclusions. In our presentation here, we'll focus on the main ones, but there are many specific exclusions from TOSI. Okay, so let me tell you a little bit about each of these three things, okay? Remember, TOSI applies when a specified individual earns split income from a related business. So first of all, who is a specified individual? For the tax folks in the audience, this is defined in this section of the Act, so feel free to mark that down if you'd like. A specified individual basically is a human, okay? A person, a real life being, okay? Not ChatGPT or anything like that, but a human who is either an adult resident in Canada, okay? Or a person who's under the age of 18, meaning a minor with a parent who's resident in Canada, okay? So a specified individual is either an adult resident in Canada or somebody who's under the age of 18 with a parent resident in Canada. Ladies and gentlemen, please tell me in the chat if you don't mind, okay? Is this a very broad definition? Does this capture like a lot of people in Canada? Or is this a very narrow definition, meaning it captures very few people? Based on what you're seeing here on my screen, is this going to capture a lot of people or very few people? What do you think? Please let me know if you, in the chat if you don't mind. Will this capture a lot of people as a specified individual, or will this be very, very few people? Christian, Rebecca, yes, thank you. Absolutely. Yeah, this is a very, very broad definition. This is almost everyone in our country, basically. Folks, can you think of a person that is not a specified individual? Can you think of someone, Jeffrey, muchas gentes, love it. Can you think of someone who doesn't meet these parameters? What kind of person would not be a specified individual and therefore doesn't have to worry about TOSI? Who could that be? Who could this be? Well, I'll give you a hint. It's not an adult. It's someone who's under the age of 18. And what does that person have to do to not be subject to TOSI based on what you're seeing on the screen here? And folks, by the way, in Zoom, you can send me a private message. At the very bottom of the Zoom window, there's a little thing called private message. So if you're If you're embarrassed to say something because Jeffrey is here, I get it. Okay, Jeffrey, he's on the ball, but feel free to send me a private message. No problem. Yeah, Rebecca, thank you. Canadian, yeah. The only real person based on this definition that's not going to be a specified individual is if you're a minor living in Canada, but your parents live outside of Canada. So this potentially could be a student, for example, who came from another country to study in Canada and stayed for a long time, for instance. So folks, chances are any individual, any taxpayer you're going to deal with is going to be a specified individual. So it's almost a foregone conclusion that someone who's receiving income, they're going to be a specified individual. Okay, next, what kind of income is considered to be quote unquote split income? Well, the traditional definition of split income, when this happened back in 1999, were dividends from a private company, from a non-public company. But over the years, people got creative, okay? They said, okay, fine, I can't pay a dividend out. Sure, I'll pay something else out, or I'll create a partnership, or I will sell shares, which is a capital gain, which is not a dividend, etc. And so over the years, the definition of what split income is has added all of these different additional parameters. The original point was dealing with dividends. But over time, the definition of what is subject to TOSI has grown to cover all of these different things, ladies and gentlemen. Now, folks, can you think of two types of income that are split income and therefore not subject to TOSI? Look at this list. Can you think of there's two types of income that you probably can easily think of, hopefully, that are not on this list. Can you think of something that a person might receive that is not here, and therefore is not considered to be split income, and therefore is not TOSI? Yes, Rebecca, thank you for answering. For sure, wages. Salaries and wages, ladies and gentlemen, are not on this list, okay? So if you choose to pay a salary, a wage, or a bonus to a particular person, forget TOSI. You don't have to worry about TOSI. And maybe that's a reason why you might want to pay it in the first place. But what you do have to worry about is the amount reasonable, as per our earlier conversation. The other thing that would not be subject to TOSI by definition would be dividends from a public company. If a person is receiving dividends from a public company, notice it's only non-public company dividends that are subject to TOSI. But really, you can't really split income per se with public company dividends, or at least not to the same degree as out of a private company, because who decides if a public company pays dividends? The board of directors of the public company, right? And for that reason, it's not subject to TOSI. Also, capital gains dividends that a public corporation can pay, or CDA, which is non-taxable, there's no tax there to deal with as well. So anyway, but wages and salaries, notice, ladies and gentlemen, by definition will not be subject to TOSI. So if part of your compensation strategy is, I don't want to deal with TOSI, it's complicated, I don't want to confuse my client, well, maybe that's a reason why you might want to pay wages or bonus in the first place. Okay, last but not least, so we have a specified individual, basically just about anyone in Canada, earning some kind of split income. Let's look at the traditional definition, private company dividends. And the third component is it has to be coming from a related business. Now, to understand what a related business is, there's a concept called a source individual. Think of it like this. If I'm a specified individual and I'm getting income from a company, a source individual is someone that I'm related to, and that person either runs or operates or owns the business that is paying me this dividend. So a source individual is somebody who's a resident in Canada who is related to me if I'm the recipient of that particular income. Folks, individuals can be related through blood, being part of the same family tree. For example, mom and dad, or mom and son, dad, daughter, two siblings would be related. Marriage, so two spouses are considered to be related. If you marry your spouse, you become related to their family tree, to their mom and dad, their in-laws, etc. Or if a person is adopted, they are considered to be basically part of the same family tree as well. So this is how individuals could be related, essentially. There's a special rule for separated spouses, okay? If during the year, two spouses are living separate and apart because of a breakdown of their relationship, they're deemed not to be related for TOSI purposes. So folks, here's your chance to get out of TOSI, okay? Go ask your other half, honey, you know, the tax guy on the seminar said, if we're separated, no TOSI. So here, please sign here and move out and all our TOSI problems are gone. Try that at home. Let me know how it goes. Probably not the best way to plan yourself out of TOSI, but technically that's possible. Okay, so what exactly is a related business? Okay, it's a business that is either carried on by a source individual or carried on by some kind of entity if a source individual is running it, or specifically a corporation of a source individual owns at least a portion of it. So folks, in the traditional example, let's say my father owns a corporation. and I'm some kind of beneficiary of a trust that also holds shares in that company. I'm related to my father, so my father would be the source individual. If my father owns or operates that company, to me it's a related business. So if that company is paying me a dividend, it's going to be subject to TOSI because I, a specified individual, am getting a dividend, aka split income, out of a related business. So that's essentially what this is focusing on, ladies and gentlemen. Notice that if you're working for an arm's length company and you happen to receive a little bit of a dividend, but it's in an arm's length situation, there's no TOSI there. TOSI is really for family businesses in that context. Okay, so folks, remember, since 2018, TOSI is applicable to a specified individual, essentially anyone in Canada. If they're earning something called split income, in our context here, we'll focus specifically on dividends from a related business, i.e. a relative of mine owns or operates a business, they're paying me a dividend. That's a related business. When those three things are met, I got to worry about TOSI. However, there are exclusions. And if I can somehow squeeze myself into some kind of exclusion from TOSI, then maybe TOSI is not applicable to me, in which case I can receive a whole bunch of dividends, pay tax at the low rate, and my family saves tax overall. Not a bad situation. Folks, there are many, many, many exclusions from TOSI. And in my humble opinion, I think this is really the complexity, the particular complexity of these new rules. Some of them are based on age. Some of them are based on how involved the person is in the family business, what contributions they might have made. If they own shares, what kind of shares they own. There's special circumstances for, life events, somebody passing away, things of that nature. This is probably the most challenging part of it. So we're going to focus on, there's three what I describe as main exceptions from TOSI. We'll take a look at those because they have, in my humble opinion, wider application. But there's many other ones which we're not going to cover. If there's an appetite for maybe doing a more advanced TOSI session at some point in the future, happy to do it. But for today, we'll focus on just a couple of them. Okay, so there are three what I would describe as main exclusions from TOSI. They are called excluded business, excluded shares, and something called reasonable return. So if a person who's receiving a dividend out of a family business can squeeze themselves into one of these three things, they're going to be excluded from TOSI. Therefore, paying tax at the normal rate. Therefore, my family is saving tax overall as a result. Okay, for these exclusions, little details make a big difference, ladies and gentlemen. In taxation, as I'm sure you've probably realized, little details, little words, little nuances sometimes make a giant difference. And it's true particularly in this case. Okay, let me tell you first a little bit about the excluded business exception. Again, let's suppose I'm a specified individual. My father's company is paying me a dividend. Normally, I would be subject to TOSI. But if I can meet some conditions under the excluded business exception, TOSI doesn't apply, and therefore I would pay tax at my marginal rate. Maybe me and my dad as a family would now save tax. Okay, the excluded business exception really looks at whether the person who's receiving the income is actually involved in the family business. Do they actually work in the family business? That's really the question. And the specific requirement says the following: is the individual actively engaged on a regular, continuous, and substantial basis in the business? That's a lot. Actively engaged on a regular, continuous, and substantial basis. Now, how could you show to the CRA if you are actively engaged on a regular, continuous, and substantial basis? Well, there's two ways to do this. There's a special rule called the deeming rule, that if you can show that you work at least this much, they assume you're actively engaged. And if you work less than that, then you have to show them through some sort of factual determination that, hey, my contribution is regular, continuous, and substantial. Okay, if a person works at least 20 hours per week on average during the time when the business is operating, then they're going to be deemed to be actively engaged, and therefore they're not going to be subject to TOSI. So one way to get out of TOSI is make your kids work 20 hours a week for your business, okay? Son, I know you're only 15, but daddy's got taxes to save. So you're going into the family business 20 hours a week, and eventually you can stop, but for now, please go ahead. So a person who's working 20 hours a week on average would be deemed to be actively engaged on a regular, continuous, and substantial basis. They don't have any TOSI issues. If a person works less than 20 hours a week, they can perhaps be able to demonstrate that their contribution is regular, continuous, and substantial, but only if they can show that factually. In other words, maybe I work 16 hours a week, but my contribution is so critical that without me, the business would collapse. And therefore, my 16-hour-a-week contribution is therefore substantial. That would have to be determined on a basis of question of fact. But 20 hours or more, you're deemed to be actively engaged. Now, there's also a question here of timing. So when is it that I need to work at least 20 hours a week or some lower number if it's substantial? And there's two possibilities here as well. Either during the current taxation year, during the time when I'm receiving dividends from that family business, or during any 5 previous taxation years. So ladies and gentlemen, quick example. Let's suppose my father has a business. The business is paying me a dividend. If I am working at least 20 hours a week this year, and the dividend is coming to me this year, then that dividend would be excluded from TOSI because I'm actively engaged in the year when I got the income. However, let's say this year, I'm not working for my father's business, but in the past, I worked for my father's business in 2011, 2013, 15, 16, and 18. Notice that's 5 years in total, not the last 5 years, and they're also not consecutive. But in total, if I have 5 years of service to the family business, I'm now basically grandfathered into a future TOSI exemption for the rest of my life, ladies and gentlemen. So again, you want to be excluded from TOSI? Once your kids turn of a certain age, put them into the family business, make them work. Once they've worked 5 years at 20 hours a week, they've paid their dues, they earned their keep, and your TOSI problem is solved, ladies and gentlemen. Okay, now, this is available to adults only. So who can use the excluded business exception? Someone who's 18 or older, all right? 18 or older. So you have to be either already 18 during the taxation year, or if you're turning 18 during that year, that's okay as well. If you're turning 17 and you're going to be 18 in the following year, unfortunately, you still have a TOSI issue. Also, a little interesting tidbit. The 5 previous taxation years could be at any point in the past, regardless of how old the person was during that time. So for example, if I'm 18 today, guys, I wish I was 18 today, okay? I'm in my 40s now, but if I was 18 today, okay, and I worked for 5 years as a teenager for my father's business, I, starting from the age of 18, would be excluded from TOSI, even though when I worked, I might have been 13, 14, 15, whatever the case might be. So interesting tidbits here, ladies and gentlemen. There's a lot of nuance here, but excluded business, you need to work in the business, okay? At least 20 hours a week or a lower number if it's substantial. Folks, I'm going to pause for a quick moment. Does anyone have any questions about excluded business? I realize this gets fairly technical, so hopefully I'll try to put a bit of an easier spin on it. Okay, no worries, no worries. And again, please, if anyone has a question or comment, please, I encourage you, please send it through the chat. Okay, the next possibility here is to meet a different kind of exception called excluded shares, And in my humble opinion, excluded shares is one of the last remaining opportunities to take a person in your family who does nothing, absolutely nothing. Okay, they're sitting on the couch watching Netflix. Okay, they're not working in the business. Okay, but if you can get them to meet these 4 conditions, they can do nothing, and you can pay them a dividend, and they are not going to be subject to TOSI. Unfortunately, these 4 conditions are pretty restrictive. Okay, so in order to meet the excluded shares condition, I need a specified individual to own shares of a corporation where 4 conditions are met, ladies and gentlemen. Condition number 1, the corporation is not, I repeat, is not a professional corporation, okay? So anyone who's a lawyer, an accountant, can do this. Now, due to the rules of our professional regulations and whatnot, if you've got a professional corp as a CPA or even as a lawyer, I believe, you can't have a non-CPA or a non-lawyer own shares anyway. So it's not really a huge issue. But do you know which category of professionals was royally upset? Yes, Rebecca, doctors. Doctors were majorly pissed off, pardon my French, when these rules came out. Because doctors for decades used to split income by having non-voting shares issued to wife, husband, son, daughter, etc. Yeah, dentists, I believe would fall under the same category. But yeah, medical professionals in the past used to split income, but as soon as this came in, unfortunately, they can't do it. So what this means is I need to have a corporation that's not a PC, okay? Anything that's a PC, unfortunately, to paraphrase from Seinfeld, no soup for you, okay? You're not going to be able to split income, unfortunately. Okay, next, let me look at the second condition. Less than 10% or no more than 10% of its prior year income is derived from another related business. So what this really means is I can't have a company that's really acting as a flow through. For example, you might have a company that charges a management fee to another business and then simply pays out that management fee as a dividend. That management fee would be coming from another related business. So if that's the case, if your company is just a flow through from some kind of fee from another related business, no good. But if your company truly has its own clients and truly generating income from, from selling a product or a service, fine. It just cannot be acting as a flow through for something else. So this, for example, may apply to holding companies, potentially. Okay, condition number 3, less than 90% of its prior year business income was from providing services. Okay, let me say this a second then, ladies and gentlemen. Less than 90% of its prior year income was from providing services. So what does this mean? If my corporation purely is a service business, perhaps an engineer or a consultant or whatever, 100% of my income is from services, which is not less than 90%. I therefore fail this test. Alternatively, if my business, let's say, is a convenience store, 100% of my income is from selling a product. 0 is from services. Therefore, I meet this test. What if I have a business that is partially a product, partially a service? For example, a hair salon. By the way, I'm slightly overdue for a haircut. I'm going in a couple of weeks. So when I see my hair stylist, whose name is Vince, by the way, Vince, shout out to you. When I see my friend Vince, he's going to cut my hair. That's a service. But he also sells hairspray, hair gel, hair whatever. That's a product. So if he wants to split income with someone, he would want to make sure that his sales of products, aka hairspray, etc., would be more than 10% of his gross revenue. And folks, this is gross business income, i.e. gross revenue, not net profit. So essentially what this is saying is you cannot have a business that is purely a service business. Folks, I don't know if you agree, but I think our government, unfortunately, doesn't like professionals very much, doesn't like service providers very much, okay? Otherwise, they would have different rules in this area. Okay, last but not least, and this is an important rule, the individual needs to own shares directly that have at least 10% of both votes and value in order to qualify for this exclusion. So in other words, if my father has a company, I need to own at least 10% of that company's shares directly, not through a holding company, not as a beneficiary of a trust, but directly. And those shares have to give me at least 10% of both voting rights and also value. Because you can have shares that have voting rights but no value, or vice versa, have a lot of value but no voting rights. I need something that gives me 10% of both. So essentially, if you want to split income with someone, you got to make sure you're not a PC, not purely a service business, not a flow-through entity for something else. And lastly, you're willing to give up at least 10% of votes and value to the individual that you want to split income with. Okay. But if you manage to do all that, that person can receive dividends, no subject to TOSI whatsoever, and technically doesn't have to do anything. Okay. No labor, no contributions of any kind, etc. So for someone who's inactive, this is one of the ways they might be excluded from TOSI. But again, depending on the business profile, may be hard to do, may be impossible to do if you're a service business, for instance. No, also, this is available only to adults who are at least 25 years old. Okay, notice that the 25-year-old category basically excludes anyone who's a student. If you're a student between the ages of 18, 22, 23, you're not in this category, okay? Folks, prior to these new TOSI rules, a very common planning technique was as soon as a person turned 18 to pay them dividends in order to fund their education. Well, the government caught on to that, and this is why they put in this 25-year minimum requirement as a result. This is also a relevant exclusion at a point in time. So when, at the time that I'm receiving a dividend, at that time, do I own at least 10% of the shares? Do I meet all those other parameters? So potentially, if I have changes in share ownership during a year, that may change whether I qualify for this exclusion or not. Okay, last but not least, the last main type of exclusion from TOSI is something called reasonable return. Reasonable return basically says this, okay, fine, you don't work in the business, okay, fine, you don't own any kind of shares, okay. Is there any contributions of any kind that you as an individual have made for this business? Maybe you contributed some kind of property, okay? Maybe you assume some kind of risk. Maybe you guaranteed a loan for the family business. Maybe there's some other factors in play where, I don't know, maybe you're the creative driver behind the business, something along those lines. If there is something that you've contributed to the family business, then you can receive a reasonable return on whatever you've contributed. Now, CRA has been repeatedly asked, what exactly is reasonable? And the CRA has repeatedly said, it's a question of fact, okay? We cannot really tell you what's reasonable in one situation or another. It's a question of fact based on a specific set of circumstances. They did also say that they won't substitute their own judgment unless there was no good faith attempt made. Fine, but do we have a lot of guidance from them on what is reasonable? Not really, not really. Lastly, this is also only available to adults who are at least 25 years or older, not to anyone who's under the age of 25. So, ladies and gentlemen, to recap, there are three main exceptions from TOSI. Excluded business, you need to work in the business, at least 20 hours a week or a lower number to be substantial. Number two, excluded shares. I need to have a certain kind of business where I own at least 10% of votes and value in that business directly. And lastly, reasonable return. Fine, I don't work, I don't know anything. Have I contributed anything at all of value to the business? If so, I'm able to get a reasonable return on that. Okay, ladies and gentlemen, I have a quick yes or no question for you, okay? Please look at my slide and tell me in the chat as a response, yes or no to my question. Have you ever heard of something called the TOSI flowchart, seen it in real life, or maybe actually used it? Hopefully the tax folks in the audience know what I'm talking about, but for anyone who's not, have you heard, seen, or used something called the TOSI flowchart before? Please let me know. Okay, so we've had some yeses, we had some nos. Okay, fantastic. So no worries. It's a bit of a mixed bag, no problem. So ladies and gentlemen, there's a very, very handy guide or flowchart that is publicly available that, in my humble opinion, is a fantastic practical tool for dealing with TOSI if it ever is something that you have to deal with. Perhaps if you're deciding who to pay a dividend out of your family business. Okay, it's published by a company called Moody's. Moody's is a law firm and they specialize in the area of taxation. The person behind Moody's is a well-known individual in the area of taxation, has published various articles, and so on and so forth. Folks, if you go on Google and type in Moody's TOSI flowchart, okay, make sure there's a PDF document that comes up. It might be the second or the first hit, depending on, you know, your Google algorithm. Here's the source for it. My point of the story is it's a publicly available document. You can easily see it. And I'm just going to quickly show you what it looks like, especially for those of you who have never seen it, to get a sense of what this thing is all about. Okay, just give me a moment here. We're going to close this down, open up something else, and just give me a moment. I'm going to share a different document. Here we go. Okay. Ladies and gentlemen, just a quick yes or no question. Can you see on your screen a little PDF? It says simplified TOSI flowchart at the top. Yes? Beautiful. Fantastic. Thank you. Okay, so first of all, ladies and gentlemen, I'm just gonna, and again, please go online, download it. It's free. Okay. Moody's, as far as I know, doesn't charge royalties for this thing, and if they do, man, they would make a killing. Okay, because everyone uses this thing. Anyway, if you do a quick scroll through this document, notice there's all sorts of questions, yes or no. There's all sorts of arrows pointing in whatever direction, and there's different boxes in different colors. And this whole thing is called simplified. Okay, ladies and gentlemen, does this look very simple, this flowchart? I don't know, certainly not simple. Unfortunately, TOSI by its nature is not simple, but this is probably as simple as it could be. Hence the term simplified, which I think Moody probably used correctly in this context. Ladies and gentlemen, I would like to have a little bit of fun with this, okay? Because, you know, in my opinion, tax could be a fun thing if you approach it the right way, okay? It could be a very non-fun thing as well, but if you approach it the right way, it could be something that's fun, maybe even humorous. Folks, let's pretend that the TOSI flowchart is basically a board game, okay? We're gonna play the TOSI board game. Let's see if we can win, okay? Maybe we can win. I see Christina smiling. Christina, that's awesome. Fantastic, you've got a sense of humor, love it. Okay, folks, if you've ever played a board game, there's usually a starting point. Okay, this is our starting point. Okay, this is the go square in Monopoly. Okay, this is where all the action commences from. Okay, we're going to start over here and we're going to be asked a series of different questions. Okay, and our whole objective here, okay, is to land on a green square. Okay, if we land on a green square, that means the TOSI rules do not apply. Score. Therefore, we don't have to worry about it. Unfortunately, there's only 2 green squares and there's also 2 very sizable orange squares. And you don't want to end up over there, okay? If you end up over there, you've lost the TOSI game. TOSI is applicable to you. You know, too bad, how's that? All right, so let's take a quick look at this, and I'll just show you high level how to use this thing so that if you ever have a TOSI issue in real life, I would suggest use this TOSI flowchart. Okay, so first question, and let me make this a little bit larger, just in the interests of people being able to read it, hopefully. The first question is, are you a specified individual? Okay, remember we looked at specified individuals? Pretty much everyone is a specified individual. So if you say yes, the TOSI game continues, okay? If you say no, you've won the game, end of story, but most people, unfortunately, are going to be specified individuals. We then go over here. it asks you, did you earn any of the following kinds of split income? And it tells you all of the different kinds of split income. Notice that taxable dividends from a private company is like item number one, okay? So if you're paying out a dividend, yeah, that's gonna be split income, unfortunately. So if the answer is yes, the game continues. If the answer is no, you've won the game. Okay, these items in here, I would describe these as special exceptions from TOSI, okay? They're really based on life events for the most part. In my humble opinion, it's a little bit difficult to plan your way into them, okay? So for example, it talks about a person who receives some kind of property as a result of the death of your parent, okay? That's a tragedy, okay? But at least you don't have to worry about TOSI. Was the property transferred to you because you've separated or you had a breakdown in your marriage or common law relationship? Again, not a great thing to occur, but if it does occur, perhaps there's no TOSI on that property. Is there a deemed disposition on death? Good news, there's no TOSI. The bad news is, well, you died, so you kind of don't care about TOSI at this point, but I guess your executor will have an easier time. Fantastic, fantastic. Folks, last but not least, this is a special exception called the 65 spousal exception, okay? If you have a spouse and they are age 65 or older, then you are excluded from TOSI if they are excluded from TOSI. And it doesn't matter how old you are. What matters is that your spouse is 65 or older, and if they're excluded, you're excluded, okay? So ladies and gentlemen, I don't know how many of you are currently single and ready to mingle, okay? But if you are, notice you can potentially marry yourself into a TOSI exception for the rest of your life, okay? There you go. So spouse 65 and older, often overlooked, but very, very valuable. I see some smiles. Fantastic, wonderful. Okay, assuming none of these special circumstances apply to you, we get to this point and we now have a fork in the road. Notice it says age 18 or over, go left, under age of 18, go right, okay? Folks, you hope to stay on the left side of this game, okay? Nothing good happens on the right side. It's like the dark side. You go on the right, that's it, forget it. You've essentially lost the game. But if you can stay on the left, 18 or over, maybe we have a shot, okay? So if we are 18 or over, we are now being asked various questions. Do I have a related business? Okay, am I earning income from this related business? Because if not, I don't have to worry about TOSI. If it's my mom's or dad's company, yeah, I got a related business. I got to keep going. I'm then being asked, do I have an excluded business? Remember, do I work at least 20 hours a week for this thing? If the answer is yes, I'm excluded. If the answer is no, the game keeps going. And here it splits into two age categories once again. If I'm age 25 or over, I stay to the left. I have a shot of winning, okay? Do I have excluded shares? If so, I've won the game. If not, my last shot is at a reasonable return, okay? And so eventually, when you go through this flow chart, if you land on either this green square or this one, no TOSI for you, fantastic. But unfortunately, it's hard to get to those things. And if you end up on one of these, well, unfortunately, TOSI is subject to the income that you've earned, okay? So folks, in a very, very quick nutshell, this effectively is the TOSI flowchart, okay? Especially for those of you who have never seen it or heard of it, may I suggest if you're ever dealing with the issue of TOSI, take out the flowchart, start at the very top, right here, and work your way down through these various things. And you hope that you end up on the left, okay, where the green squares are, okay? In my humble opinion, very, very useful, practical tool, ladies and gentlemen. Okay, with that in mind, let me go back to our presentation and we shall continue from that point. Just a moment. There we go. Okay, Lejean, so please correct me if I'm wrong, but I think you should be able to see my slides now on your screen once again. Yes, fantastic. Okay, wonderful. Okay, so now that we've looked at the concept of TOSI when it comes to dividends, let's look at a couple of other things that may impact whether we can pay a dividend out of a company for purposes of compensation, okay? If you have a shareholder that owns common shares by their definition are pretty much always voting, they're always dividend bearing, okay? There could be some slight variations on that theme, but generally speaking, if you're a common shareholder, you can receive a dividend and there's really no limitation on the dividend you can receive. But if you're a shareholder that holds preferred or special shares, those shares may or may not be dividend bearing. Some preferred shares don't have the ability to earn dividends, unfortunately, but that's possible. And also the amount of the dividend may or may not be limited. Certain kinds of preferred shares have a fixed dividend amount. It could be expressed as a fixed amount per year or perhaps as a percentage of the overall share value. So if you have that, you need to know what the limit is because you cannot legally pay a dividend on those shares that exceeds the limit that is predicated or is contemplated in the share structure. So The biggest thing I would say is if you're ever seeing a shareholder that has preferred shares, anything that's not common, go and find the articles of incorporation for that company, or perhaps the articles of amendment if they were amended subsequently, and read what characteristics does that particular class of shares have. Do they have the ability to receive dividends? Because if they don't, or if they have a limited amount of dividends they can receive, that's going to impact whether you can pay a dividend out or not, or how much of a dividend you can pay out. And this is very common in a structure where, for example, somebody did an estate freeze. Okay. Now, if you have an individual who owns special or preferred shares, and you would like to give some kind of large distribution to that individual, and they're limited in terms of how much of a dividend they can legally receive, a common strategy that you could potentially use is instead to redeem those shares. Redeem those shares. Redeeming shares is not the same as paying a dividend on them. Redeeming shares means you're actually buying those shares back. So in other words, the corporation would give money to the shareholder, and the shareholder gives back a portion of those shares back to the corporation. The corporation is basically buying back some of its shares and cancels those shares. For tax purposes, a redemption creates a deemed dividend under Section 84 sub 3. A deemed dividend means this is not really a dividend, it's a buyback of shares, but we're going to pretend like it's a dividend. So effectively, it accomplishes the same exact objective as paying out a dividend. A deemed dividend is treated as a taxable dividend paid. So it'll get you back your RDTOH, for example. It'll be subject to taxation in the same way that a dividend would be subject to taxation, etc. But instead of paying it out on shares, you're actually buying back a portion of your shares. The way that the deemed dividend amount is computed in this context would be the difference between the proceeds that the person receives, so the cash that the company gives that person in exchange for the shares, minus something called paid up capital, or PUC, of the shares that were physically redeemed. So that difference between the amount of money they get and the PUC is what is then characterized as a deemed dividend. And it's treated as if the company actually paid a dividend, except they didn't. They bought back a portion of that person's shares. Sometimes people ask, well, what exactly is PUC? How do I figure out what PUC is? Is PUC the same thing as cost? PUC is not necessarily the same thing as cost. Paid up capital is calculated at the corporate level, and it's actually averaged out for all the shares of a particular class. So for example, if I have common shares and there's multiple people holding common shares, even though we might have different costs, our PUC will be averaged out. We will all have the same PUC per share. The same will occur for a specific class of preferred shares, a specific class of special shares, etc. If you have a situation where you have a sole shareholder and this individual bought their shares directly from the company when it was incorporated many years ago, and there's no other shareholders and no other share transactions, your PUC and ACB will be identical, okay? But if you have a new shareholder that buys their shares from an original founder of a company, presumably at a different price, that person's ACB would likely be higher than their PUC, okay? So folks, don't assume PUC and ACB are the same. They're not the same. PUC is calculated at the level of the company, whereas ACB is individual to a specific shareholder that bought the shares at a specific price. A quick sort of guide to what the PUC might be is if you look at the balance sheet and if you look at the share capital on the balance sheet. That number may not always equal exactly PUC, but in a lot of cases will represent what PUC is. Okay, so keep in mind, PUC and ACB are not the same. In this context, ladies and gentlemen, when it comes to a share redemption, there's a strategy that tax planners sometimes use, referred to as a wasting freeze. A wasting freeze sounds a little bit funny, wasting freeze, but nonetheless. This is oftentimes a technique that is used subsequent to a transaction called an estate freeze. An estate freeze is basically a situation where an original founder exchanges their shares for some kind of special shares, which are fixed in value. Somebody else subscribed for common shares. Those common shares will grow in value moving forward. Well, those preferred shares that are issued on an estate freeze are typically subject to a limited dividend, okay, because of certain CRA rules. So if those shares are now remaining outstanding in the hands of the original person and you want to pay them a dividend, you may not be able to, or you may not be able to pay as high of a dividend as you want. So instead, you may want to redeem them. And if you redeem such shares, especially if you do it over time, there's basically two benefits. That person is able to receive the deemed dividend. So effectively, you're able to pay cash to them and have it treated as a dividend. But also, gradually, it reduces the amount of shares that that person holds, which reduces their value. And eventually, let's say if the individual passes away, as you probably know, there's a deemed disposition at fair market value on death. The value of those shares would not be lower. So you now have a lower amount of a potential capital gain on death. So lower tax implications to deal with on death. So fairly common strategy if you see preferred shares in a corporation, particularly when an estate freeze was done in the past. Okay, last but not least, let's take a look at dividends paid to a trust. Folks, in my humble opinion, it's very common to see a corporation and some kind of shares of that company are held by a trust. This again could be as a result of some kind of estate plan, or it could be simply because they want to allow the future growth to perhaps be spread out amongst many people, multiply the capital gains exemption, et cetera, et cetera. Folks, trusts can receive a dividend on the shares that they own in a corporation. A trust is treated as a normal shareholder. So if you have a corporation and a trust holds shares, you can pay a dividend on those shares to the trust. The question then becomes, what does that trust do with that dividend? A trust is a little bit of an interesting entity for tax purposes. A trust can either pay the tax on that dividend itself, or it can allocate the dividend to some kind of beneficiary or multiple beneficiaries out of the trust. Trusts that are created during a person's lifetime are called inter vivos trusts, and they're automatically taxed at the highest possible tax rate, the same for individuals. So for that reason, when you have a trust and you're paying some kind of income out to the trust, it's usually not the best tax idea to leave the income in the trust, because there's going to be a lot of tax payable by the trust on that income. They're going to be paying tax at the highest rate. Or the trust can actually allocate that dividend to its beneficiaries. And if it does that, that income is then taxable in the hands of the beneficiaries, not the trust. So again, the outcome here is, if you ever see a trust as a shareholder, don't freak out. You can pay a dividend to that trust, and the trust can in turn allocate that dividend to some kind of shareholder as well. Things to watch out for when you're dealing with a trust would include, okay, you might have different kinds of beneficiaries. I don't know how many of you are familiar with trusts. I know some people may be, some people may not, but a trust could have what's called an income beneficiary, and it could have potentially a different capital beneficiary. An income beneficiary is a person who's entitled to the income of the trust, but not its capital, not its property, or not its assets. Whereas a capital beneficiary is entitled to the assets, but not the income. You might have a trust where you have beneficiaries that are both income and capital beneficiaries, or they might be different. And so if you're trying to allocate a dividend out of the trust, you need to know who your income beneficiary is, because that's who's entitled to receive it, not a capital beneficiary. You could also have something called a discretionary versus a non-discretionary trust. A discretionary trust is where the trust can decide which of my beneficiaries gets the income and in what proportion. For example, if I have 4 different beneficiaries and it's a discretionary trust, I can pay my whole income to one person and exclude everybody else. Or I can split it 50-50 between 2 people and exclude the other 2 people. Or I can split it evenly amongst all 4. It's up to the trust to decide. A non-discretionary trust is where the trust deed by the settlor who created it specifically says this is how all income is to be distributed. And in that case, you don't have a choice as a trust. You have to split it in a certain proportion. In my humble experience, most family trusts tend to be discretionary to allow for maximum flexibility when it comes to income payments. Also, you might have a corporation as a beneficiary. It's possible. And if you have a corporation as a beneficiary, that corporation likely would be considered connected with the entity whose shares the trust holds, and therefore there could be Part 4 tax implications there. So anyway, long story short, folks, if you have a trust, can you pay a dividend to a trust? Yes, you can. Be sure to check the trust deed, the document that created the trust, to see, do I have discretion or not? And who are my beneficiaries, particularly the income beneficiaries? Those are the ones that I can allocate the income out to. Okay, ladies and gentlemen, so in the last 20 minutes or so that we have left, and we may do this a little bit sooner, but I just want to remind you, we did a quick case study the last time we saw each other when we looked at tax compensation strategies, the fundamentals. We looked at a company called Canadian Consumer Products Corporation, conveniently abbreviated as CCPC. Coincidence? I think not. This company sells consumer products, has some additional investments that it bought, and it has no associated corporations. It has mom and dad who run the business, both actively involved. Each one gets an annual salary of $250,000 per person, which, notice, already puts them in the highest marginal tax bracket. Now, let's pretend that mom, her name is Marge. She holds 100% of the preferred shares. Okay, her preferred shares have a limited dividend. Let's say we have a family trust that holds 100% of the common shares. The dad, whose name is Homer, is one of the beneficiaries. Okay, and there's 3 other beneficiaries for the children: Bart, Lisa, and Maggie. They're 25 years old, 21 years old, and 17 years old. The first guy doesn't work in the business at all. Lisa works 16 hours a week. Maggie works 24 hours a week. Ladies and gentlemen, I realize a lot of you are very young. But do you know where these names are coming from? Homer, Bart, Maggie, Lisa. For anyone who's a 90s kid like myself, this is from a sitcom called The Simpsons. There you go. Thank you. If you haven't heard of The Simpsons, you haven't truly lived until you've heard of The Simpsons. So please, Google The Simpsons. Okay, here's a quick diagram, ladies and gentlemen. Okay, so here's my corporation, CCPC. I've got Marge, the mom. She's active. She owns 100% of the preferred shares. Preferred shares have a limited dividend. Here's a family trust, owns 100% of the common shares, and I've got 4 beneficiaries, okay? It's a discretionary trust. They can allocate anything to anyone. We've got Homer, who is dad, who's active. Bart, not active. Lisa, active a little bit, 16 hours a week. Maggie works 24 hours a week. Different ages of different individuals here. Okay, so ladies and gentlemen, you may recall last time we saw each other, you had a set of financial statements and a T2 for this particular company. And the owners wanted to withdraw $300,000 of cash in a tax-efficient manner. Okay, hopefully there's some recollection here. You may remember that our company had a due to shareholder balance, a CDA balance. They had some GRIP, some eligible RDTOH, and some NERD, as Sabrina calls it, in order to, potentially recover it with some dividends. And so we decided, again, from our previous session, that this is how we're going to compensate our shareholders. We're going to first repay the due to shareholder balance because it's tax-free. We're then going to distribute a $50,000 capital dividend because it's tax-free. We're then going to pay out a $30,000 eligible dividend and a $48,000 non-eligible dividend to recover the RDTOH, giving us a fairly low net tax paid if you consider personal tax versus the savings on the corporate side. And lastly, we decided we're going to pay the remainder $150 as a bonus, okay? So overall, we were going to pay $300,000 out in these different ways, okay? Now, why do I bring this up? The question now comes up, well, who do we pay this to, okay? We've got mom, we've got dad, we've got 3 kids, okay? Does all of this go to mom? Does all of this go to dad? Do we split this 50-50 between the two? Can the kids receive something? And if so, if the kids presumably are in a lower tax bracket than mom and dad, maybe there's a tax benefit there. Maybe there's some additional savings to be had if we can make this work, okay? So let's take a quick look at how this might plan out, and let's see what you guys think. Okay, so first and foremost, if we're repaying a shareholder loan, okay, this needs to be paid back to the specific shareholder that lent money to the corporation in the first place. So if it was mom who put money into the company and you owe money to mom, the money needs to go back to mom. If it goes out to dad, you're going to have a shareholder credit with mom, a shareholder debit with dad. And CRA will say these are 2 separate shareholders, these are 2 separate loans. So dad's going to have a shareholder benefit, mom's still going to have a shareholder credit. So make sure that if you're repaying the shareholder loan, it goes to the specific shareholder that lent the money in the first place. The $50,000 of a capital dividend, this would be a tax-free distribution. So this potentially can go to any particular shareholder. It's tax-free. Now, there might be a benefit here to perhaps use that wasting free strategy that I discussed earlier with Marge. Because remember, Marge has preferred shares. And you may or may not be able to pay the whole CDA out to Marge as a regular dividend. But if you redeem $50,000 of Marge's shares, that'll create a deemed dividend. You can elect to treat that dividend as a tax-free capital dividend. And what you're effectively doing is you're eliminating 50 grand of share value from Marge's hands, completely tax-free, and giving Marge $50,000 completely tax-free. So there's a bit of a sort of double win there. You're distributing something tax-free. You're also reducing the remaining value of shares that Marge has. So if Marge, God forbid, was to pass away, she would have a lower disposition at that fair market value on her death. Okay, now the bonus, ladies and gentlemen. We decided to pay out a $150,000 bonus. You can potentially pay this to Marge and or Homer. Okay, why? Because both of them are active in the business of the company. So you can take the whole 150, give it to Marge. You can give the whole 150, give it to Homer. You can split it half and half or 70-30, whatever the case might be. Why? Because they're both active in day-to-day operations of the company. And therefore, this area will say, you can pay any bonus to these people. They're really the lifeblood of the corporation. No question of reasonability. Okay. The problem, though, is they're both in the highest tax bracket. So if you're going to pay it to them, you're going to incur the highest possible personal tax cost. The question then becomes, can I pay this bonus out to someone else? There's other family members in the picture. Can one of them receive this bonus? Well, our friend Bart, unfortunately, has no involvement in the CCPC at all. So you can't really pay a bonus to a person that's doing nothing, okay? That would be considered not reasonable. And therefore, that would not be deductible to the company if the CRA was ever to catch up. So you probably don't want to do that. Could a portion maybe be paid to Lisa or Maggie? Well, Lisa or Maggie both work part-time in the family business. So could you pay maybe a bonus to somebody who works part-time? Maybe, but it would have to be reasonable. you'd have to ask yourself, well, what would another part-time employee earn as a bonus? Do I even pay out bonuses to part-time people? If so, what would that be? Chances are, if Lisa works 16 hours a week and you're going to pay her 150 grand as a bonus, that's probably unreasonable. Would you pay that to an arm's length employee who works 16 hours a week? Probably not. So you can maybe make the argument to pay some kind of reasonable bonus, but probably not the entire 150. But maybe there's a portion, perhaps, especially if you can somehow link the amount of the bonus to some kind of special performance maybe that your employees did. So potentially you can pay something out to someone who's working in the business, but certainly not to someone who does nothing. That would clearly be unreasonable, Now, what about the dividends, ladies and gentlemen? So in this example, we wanted to pay out some eligible dividends and some non-eligible dividends. Well, remember, in order to receive dividends, you have to be a shareholder. And in our diagram, Marge owns preferred shares or special shares, and we have a family trust that owns common shares with multiple beneficiaries. So you would want to, first of all, make sure that if you want to pay something out to Marge, you'd want to look at what dividend entitlement do her shares have. And if they are shares that were issued as part of a freeze transaction, chances are she would have a dividend that is limited to the prescribed rate that was in effect when the shares were issued. It would probably be something fairly small. So you may not be able to pay her a large dividend. You can perhaps maybe redeem some additional shares of hers, especially since you're already redeeming some using the CDA. But notice that will once again create a deemed dividend. And that deemed dividend, because Marge is in the top bracket, might now be subject to the highest rate of tax once again. So maybe this is not ideal. Now, can we perhaps instead declare these dividends on the common shares held by the trust? The trust is a shareholder. They have common shares. Common shares have no limitation. So yeah, I can certainly, if I wanted to, declare a dividend on the common shares that goes into the trust. The trust itself would be paying tax at the top rate. And Homer, one of our beneficiaries, already has income that puts them into the highest bracket as well. So if we do that and the dividend goes to Homer, we're not really saving anything additional here. But is it maybe possible to allocate some of these dividends to the kids? The answer is maybe, but we would have to consider this three-headed monster called Tosi. Okay. So folks, with this in mind, and I realize we have about 10 minutes left. We're almost finished here. Just a quick reminder, here's our diagram, okay? Here's Bart. Bart is 25 years old. He's not active in the business. Here's Lisa. Lisa is 21 years old. She works 16 hours a week on average. And here's Maggie. She's 17 years old, also works 24 hours a week on average. Okay, ladies and gentlemen, here's my question to you. Okay, here's my question to you. And this is the last question of substance that I have for you today. So we're almost done here. If you pay a dividend to either Bart, Lisa, or Maggie, i.e. the dividend goes to the trust on these common shares, and then the trust allocates it to, some or all of these different beneficiaries. Would these dividends be subject to Tosi? Would these dividends be subject to Tosi? Look at Bart. I'll give you a hint. Look at what he's doing or not doing. Look at his age. Look at Lisa, same thing. Look at Maggie, same thing. Can I pay a dividend to any of these people? Would any of them be subject to Tosi? Would any of them be excluded from Tosi? Because if they are, maybe then that would be a better option than paying a large dividend to Homer or Marge, because they're going to pay tax at the highest rate. But if I can put dividends into one of the kids' hands, they're going to pay tax at a low rate. So my family is going to save tax. Okay. So ladies and gentlemen, with this in mind, please think about this for a little bit. And I'm going to launch one more poll for you to consider. Okay. Again, it's a very simple one. This is an anonymous poll. Okay. Nobody knows what you said. If you're not sure, that's okay. But please see if you can give this a shot. Okay. So the question is, if I pay a dividend out of my company to a trust allocated to each of the three kids, are they going to be subject to Tosi? Okay. Folks, please take a look at your screen. You should see a little window asking you to comment. Okay. First for Bart. Bart is 25, not active in the business. Then Lisa. Lisa's 21, works 16 hours a week. And then there's Maggie. She's 17, works 24 hours a week. Please look at each of the three kids. Okay, take a couple of minutes. I know this gets convoluted. Please tell me, what do you think? Are they going to be subject to Tosi? Please tell me yes, no, maybe there's something else we need to consider. And if you're not sure, that's okay. Just say not sure. Please go ahead. Okay, so we're at about 2/3 of you who respond at this point. So thank you. I'll just wait maybe 30 more seconds, give everybody else an opportunity to respond. Yeah, please let us know. Okay, folks, amazing. So thank you to everybody who participated. We're at approximately 80% response, which is great. So let me share the results with you, ladies and gentlemen. So if you want to just take a quick look on your screen. Okay, so first of all, when it comes to Bart, most people think he's going to be subject to TOSI. 70%, it's a landslide victory, okay? Perhaps. When it comes to Lisa, we have a little bit more of a split opinion, okay? Some people say yes, 38%. Some people say maybe, 38%. So there's a sort of a split between yes and maybe. Interesting. Last but not least, if we look at Maggie, there's a very even split down the middle once again. 43% of you say yes, she's going to be subject to TOSI. The other 43 say no, she's not going to be subject to TOSI. Okay, so fantastic. So first of all, thank you for participating. And folks, really, the purpose of this isn't to, test you, okay? This is not an exam. This is just to get you guys to participate and to kind of hopefully provide some interactivity in a virtual seminar, which could sometimes be challenging. Okay, so folks, with this in mind, let's just quickly take this up, and hopefully this gives you a bit of an opportunity to sort of see exactly what pans out. So, ladies and gentlemen, let's first look at Bart. Okay, remember, Bart's definitely going to be a specified individual. His mom and dad, or his mom specifically, operates this business. He's definitely has split income. Okay. The only question here is, do you think he qualifies for any exclusions from TOSI? Does he qualify for any exclusions from TOSI? Well, unfortunately, the answer is no. Okay. He cannot qualify for excluded business. Why? Because he doesn't work in the business. He doesn't work at all. So excluded business for him is out the window. All right. Now, he is 25 years old. So at the age of 25, he might be eligible for excluded shares. But notice something, ladies and gentlemen. In order to qualify for excluded shares, you have to own shares directly. He does not own shares directly. He's a beneficiary of a trust that owns shares. So unfortunately for him, the excluded shares exception is not available either. Okay, it's not available either. If he did own the shares directly, he might have been perhaps excluded from TOSI under excluded shares. There's no reasonable return exception for him either. Why? He didn't really make any contributions of anything, didn't assume any risks, etc. So unfortunately, Bart is going to be subject to TOSI. So 70% of you were accurate. Give yourself a proverbial pat on the back. Now, if we take a look at Lisa, excuse me, ladies and gentlemen. For Lisa, same idea. Does she qualify for an exclusion from TOSI? Well, folks, some of you said she's going to be subject to TOSI, and some of you said maybe. It depends. It depends. Folks, out of curiosity, for those of you who said maybe, and you might be onto something here, what is it in Lisa's case that maybe could exclude her from TOSI? What is special in her situation that maybe could make her qualify for some kind of exception? Please let me know once again in the chat. Because you're right. For those of you who said maybe, you're correct. She may or may not be subject to TOSI, depending on something or other. What could that be in her case? What could that be in her case? Is it her age? Is it what she does? Is it her name? Yes, Mike Stoyan, thank you so much. Yes, as well. Yeah, notice she works less than 20 hours a week. So she doesn't meet this deeming test for being actively engaged. But if the 16 hours a week that she does work is considered substantial factually, then she actually would be excluded from TOSI, ladies and gentlemen. So for everyone who said maybe, you're absolutely right. It's a maybe in her case. She is under the 20 hours per week test, so she's not deemed to be actively engaged. But the question is, the 16 hours a week that she does work, that might be considered substantial. And therefore, if it is considered to be substantial based on the facts and circumstances of this situation, she perhaps might be excluded from TOSI. She's not old enough to consider either of the other two exceptions. You have to be at least 25 years old for both excluded shares and reasonable return. She's only 21. But her 16 hours a week contribution may exclude her from TOSI. So it's a maybe. If she was your client, you might want to talk to her. Well, what exactly do you do 16 hours a week? Is it something that's considerable? Is it more perhaps than maybe some of your peers are doing, maybe more than your sister and so on? So in her case, it's a maybe. She might actually be excluded from TOSI potentially. Okay, and okay, so somebody's got a good question, which is a private question, no problem, but thank you for the question. What is an example where 16 hours a week might be substantial? Great question. So one potential example, and this is just, very hypothetical, and this is just my own example really, but if you have a business where the business itself does not require a lot of hours to operate. For example, if you have a business that only requires maybe 4 days of full-time work to run in full, and you're there 16 hours a week, which is half the time, you might argue, well, you know what, this particular business is not a 24/7 operation. It's something that I operate 3 or 4 days a week. And if I'm there half the time, how could that not be viewed as substantial? Okay, so that would be one potential example. Let's say this is not the case in this situation, but let's say you have a family business that is a hot dog cart. You know those hot dog carts downtown Toronto? You go there, you buy a hot dog and whatever. There's one at the corner of Avenue and Bloor, or at least there used to be one right next to the ROM, okay? Well, if that hot dog cart was only there on weekends, because the ROM is very busy on weekends, and you're there both days on the weekend, 9 to 5, that's 16 hours a week, but it's the entire time the hot dog cart operates. How could you say that's not substantial? So great question by the person who asked it. You shall remain anonymous. Look at the hour contribution maybe relative to the entire business, or look at what is done during those 16 hours. Maybe Lisa is the mastermind behind the entire operation. So for her, it only takes 16 hours to do something that maybe other people will spend more time doing. Without her, the whole thing won't work. Again, it's very fact specific. Okay, last but not least, Maggie. Does she qualify for exclusion from TOSI? Again, you guys were split on this. A lot of you said yes, no, there's no TOSI, and a lot of you said yes, there is TOSI. So ladies and gentlemen, I suspect a lot of you in this case said she's going to be excluded from TOSI because she works 4 hours a week, which is more than 20, okay? Unfortunately, the problem is this: Maggie is only 17 years old. And as a minor, ladies and gentlemen, you cannot qualify for the excluded business exception until you turn 18. So it's nice that Maggie's working 24 hours a week. It's great. Once she turns 18, and in total she has at least 5 hours of 24-hour-a-week work, then she'll be excluded from TOSI. But while she's a minor, she goes down the right side of the TOSI flowchart. Nothing good happens on the right side, okay? She's going to be, unfortunately, subject to TOSI. Folks, some last-minute final considerations here. Are there any potential planning strategies that in this situation you might suggest if this was your client to maybe resolve their TOSI problem? Maybe. Okay, maybe. For Bart specifically, notice Bart doesn't work in the family business, but if you can distribute some common shares to Bart so that he owns them directly, okay? And by the way, a trust can distribute assets that the trust holds to its beneficiaries, and it's done on a tax-deferred basis. If you can take the trust and give Bart some of the common shares, if you can give him enough common shares so that he has at least 10% of both votes and value. Notice the CCPC operates a consumer products business, so it's not a service business. It's not a professional corporation. It does not earn income from another related business. If Bart individually owns at least 10% of the shares that give him 10% of votes and value, he would be excluded from TOSI, even though he does nothing. So one potential planning idea here is give Bart some shares that he can hold directly. There will be no TOSI on those. If you can make Lisa work an extra 4 hours, okay, she will for sure be excluded from TOSI, okay? Now, that may or may not be possible, okay, especially if Lisa's your kid. But if that's possible, then you're for sure excluded from TOSI. It's not even a question of fact. Now, Maggie, she's already working more than 20 hours a week, and she's going to turn 18 next year. So guess what? Next year, she's likely going to be excluded from TOSI. So maybe hold off on paying a dividend until next year. Pay a larger dividend next year, recover RETOH next year. Maybe you can pay Maggie a massive dividend because she's actually working in the business. So there's another potential possibility. So ladies and gentlemen, it is exactly 11:59. I do not want to keep anyone here past our regularly scheduled time because everyone, I'm sure, wants to go for lunch. So folks, some final thoughts, okay? Again, we're looking at the question of how should we be paying a shareholder out of a corporation? Well, as I hope you've seen, it's not a simple question, okay? We need to look at the tax attributes the corporation has. Do we want to do a bonus versus a dividend? One needs to be reasonable, perhaps. One needs to be paid on shares. You got to consider TOSI. You got to look at types of shares held, reasonability, etc. In general, there's no one simple answer to this question. It depends on the facts of a specific situation. So I hope from our earlier session and from this session as well, collectively, you now have a little bit of a maybe more in-depth understanding of some of the challenges and pitfalls associated with this. Ladies and gentlemen, it is exactly 12 noon. I have one final question for you today. Please tell me in the chat, okay? How did you find today's session? Was this too much information? This was a lot of information. Were the TOSI rules confusing? Was this a good session? Hopefully. For anyone who is virtually here, but is mentally an excluded business for the last 45 minutes, that's okay. Feel free to be honest. Hopefully I've added a little bit of humor to keep it somewhat light. All right, well, for the folks that are answering, sounds like it was a great session. Fantastic. Again, this material, especially the TOSI stuff, gets pretty technical. So I hope it was somewhat understandable from how we discussed it. Folks, it was great to see everyone as always. Happy end of April. Unfortunately, June is around the corner. So in the future, happy end of June. Folks, thank you for attending. Thank you for participating. Thank you for those of you who had your camera on. Here's my email if anybody wants to reach out, say hello. And folks, have a wonderful rest of the day. Have a wonderful long weekend coming up. I will see you next time, whenever that might be. Thanks, everybody.